Okay, this example problem is for performance-based stock options. So if we read the problem here, it says Gaga Corporation initiated a performance-based stock option plan for its management on January 1st, 2010. The plan provided for the granting of a variable number of stock options to management personnel who worked for the entire 4-year period ending December 31st, 2013. Depending on the net income earned by the company in 2013. No options were granted for the first $50,000 of net income. Thereafter, the following options were available based on the level of net income in 2013. So, if right here, if they hit, these levels of net income, then this is the amount of stock options that were granted. Okay, so as we go down, the exercise price for the $5 par common stock was $20 per share. The fair value of the options on the grant date was $9. Assume the market price for the Gaga stock and Gaga's forecasted 2013 net income were as follows at each of the following dates. So this is again just the now for this problem, you'll probably be given this number, but this is irrelevant. The stock price, it doesn't matter. This is the forecasted income, so this stuff does matter. And these are the dates. So the actual problem is to prepare the journal entries related to these stock options of Gaga for the period 2010 to 2013, assuming that all available options are exercised on December 31st, 2013. So our first journal entry is this right here. You debit compensation expense for $40,500 and you credit paid in capital from stock options for $40,500. And the reason you do that is right here. So the probable income at the end of 2013 as of December 31st, 2010 is $140,000. So you get that from our table right here. Okay, so come back down. $140,000 at $140,000 of net income, there would be 18,000 options granted. The fair value of those options is $9 per option. You multiply these two together to get $162,000, and then you divide that by 4. The service period is 4 years. And that would give you a 2010 compensation expense of $40,500. And that is your journal entry right here. Okay. Now, for the next year, at the end of the next year, December 31st, 2011, you would debit compensation expense again for $94,500 and credit paid in capital from stock options of the same amount. So if we go to our table again, we want the probable 2013 income as of December 31st, 2011. So that's this right here. So it's forecasted that we will have, or that Gaga Corporation will have $170,000 of net income. And that would put us at the $30,000 or 30,000 stock options. So if we come down to our explanation right here, $170,000, 30,000 stock options times $9 per option, $270,000. If you divide that by 4, that is it's $135,000. But you've got to minus what you already expensed in 2010, which is $40,500, and so that would leave your 2011 compensation expense $94,500, which is what our journal entries are. Now, one explanation right here is this revised compensation, this right here, this is the revised compensation expense for 2010 and 2011. So this is 270,000 times, well, 2/4 or 1/2. I mean, it's accounting for the 2 years of the 4 years. And the $270,000 is replacing the $162,000 from 2010's estimate, because now the estimated income is higher. So that 162 becomes irrelevant except for the 40,500 that we actually did expense. So you have to minus that from the 135, and that gives you the 2011 compensation expense of $94,500. Okay, now this one at the end of 2012, this is a little bit different. You will notice that these have been reversed. We are now debiting paid-in capital from stock options and crediting compensation expense instead of vice versa like we did the first two entries. And the reason for that is right here. So if we the probable 2013 income as of December 31st, 2012 is 135. That would take our options back down to 18,000. Each one's $9. It's 162,000. 4 years in the service period. The revised compensation expense. Now, if we look at this, it's 162,000 times 3/4, because this is our new estimated number, and it's our 3rd year, so we multiply it by the 3 out of the 4 years. That gives us 121,500. But the compensation expense from 2010 and 2011 added together is 135, which is more than our estimated expense this year. So that gives us a negative 2012 compensation expense of 13,500. So you just reverse the journal entries that we had before. Okay, now at the end of 2013, we have compensation expense. It's back to a debit, 40,500. We credit paid-in capital from stock options for the same amount. And now we have our actual 2013 income. It's 145,000. So that leaves us in the tier where we have 18,000 stock options times $9 per option. That's 162,000. If you take away, okay, so this is the 40,500 from 2010 plus 94,500 from 2011 minus the 13,500 from 2012 that was a negative estimate. And that gives us the 121,500. So you've got your total compensation expense minus the 121,500. That leaves us with the 2013 compensation expense of 40,500. And when they exercised the option on December 31st, 2013, this is cash paid for the option, $20 per share times 18,000 shares, $360,000. This is the total value of the options that were exercised, $9 per option times 18,000 shares, that's $162,000. Then you've got a credit common stock at the $5 par, that's just $5 times 18,000 shares, $90,000. And you credit paid-in capital in excess of par for the balance, which is $432,000.